So in this module, we are going to talk about credit scores. So before we actually do that, let's understand why do we need a credit score. Human beings by nature prefer a number, a quantification of any fact. So for example, if I was to tell you that a particular person had lots of money or lots and lots of money, whilst you might be able to give it an estimated number in your head, but you still will not have a benchmark. But if I tell you that he's got 10 crore rupees, then you now know what I'm talking about. Similarly, like the other example can be, you meet someone after a long time and you look at that person and say, oh my God, you've lost weight. How much weight? Lots of weight. 5 kilos. Now, which one is giving you a right estimate? It's the 5 kilos number. Similarly, a credit score from a lender's perspective actually translates the facts of a report into a number. In India, that number ranges between 300 at the lowest to 900 at the highest. What that means is the higher the score a person has, say 825, the likelihood of that person not repaying the loan is very low. And if the score is low, say 576, then the likelihood that he might default or might be delinquent is higher. This should tell you why is it that a score is extremely important. From a lender's perspective, it's important because he uses it as one of his decision tools. From you as a borrower's perspective, it's important because there are various elements that go into developing that score, and you got to be careful that you maintain those parameters within the acceptable range. So let's look at what components go into the development of a score. There are various. One is the combination of the loans you've taken in terms of are they secured loans or are they unsecured loans. Unsecured loans typically are personal loans, consumer loans, and secured loans, of course, the best example is a housing loan. A car loan is another example. Too many unsecured loans as a percentage of your total borrowings can definitely impact your score negatively. If you have credit cards, for example, the extent of credit limit that you use also impacts your score. So if you keep swiping your card and the total amount outstanding, even if it is not a delayed payment, is close to your limit on the card, then your score can be negatively impacted. If you pay your loans on time and you are never delinquent or late in your payment, then your score gets positively impacted. Another aspect that impacts your credit score is the number of inquiries that have been made on you. So if you are applying many times to various institutions to get the best price on a loan, then those institutions will pull reports on you, and the more number of inquiries therefore that they make on you is actually going to again impact your score. Now, whilst we've gone through these 4 or 5 elements that actually impact a score, what is it that really works inside? And I think that is important. So let's talk a little about why is it important and how does it actually work. But most importantly in all this is going to be how you take a credit score and build it into your decisioning process as a lender. How your credit score as an individual borrower impacts your ability to borrow and on what terms to borrow at. So all the 4 credit bureaus in India produce a credit score which they supply to their various clients, the lenders, to take decisions.